Hi, and welcome back to Drive to 5. My name's Rick. Today I'm going to go over 10 10 real estate acronyms or abbreviations to know when looking for a home or a mortgage. They're no in particular order, just things I thought of that in my experience of buying a home and working in the banking industry, things that I've learned over time, and I thought they would be important and knowledgeable for people to know. So the first one is a DTI, and that stands for debt to income ratio. It's what the banks or your lender will use as an underwriting tool to determine how much debt you are using according to how much income that you have. So, for example, they'll take car loans, credit card loans, payments, things like that, and they'll accumulate it and find out how much of your gross income is going towards that, and they'll use that as your debt to income. So typically 43% is kind of what your banks are looking, no more than 43%, although there are loans like FHA that are more lenient and will go up to 50%. So that's a debt to income ratio. And FHA is the Federal Housing Administration is what it stands for. It's a government-backed loan that's targets first-time home buyers. It's more lenient in credit score and DTI, and allows for as little as 3.5% down. That's the loan that I got when I bought this house, and that was because my credit score, I was still in the rebuilding process. It wasn't high enough yet to get a conventional loan, or it wouldn't be advantageous to me. And then they also, because it's a higher risk loan, you end up paying what's called PMI every month, and we'll go over that next of what that means. And it's basically a fee. You pay every month, and you'll pay a fee at closing. I believe it's 2% of the loan amount at closing, and that's just to participate in the loan. Not everybody realizes that when people talk about FHA, is that there is an upfront fee, but there's also a monthly fee. So, for example, they're also, the other side of it is they're also more strict in their appraisals. So when you have an appraiser come to find the current value of your home, they're more strict in that. So, for example, mine didn't have a stove in it, and for FHA appraisals, that's something that's needed. So I had to make sure that a stove was in the home, or call the other party's contact to make sure that a stove was in there before, or FHA would not qualify me for the loan. So that's what an FHA loan program is. The next one is PMI, like we talked about. That stands for Private Mortgage Insurance. And what that is it's a monthly fee that you have to pay because you've put less down. So typically, if you put anything less than 20% down on a home loan, on a mortgage, you're going to have to pay some kind of private mortgage insurance. And so, for example, with an FHA loan, if you put less than 20% down, which most people do because you can go as low as 3.5% down, you're going to have to pay private mortgage insurance every month, and that's added on top of your PITI, which we'll go over next, actually. And so the only difference, though, is you pay PMI no matter if it's an FHA or conventional if you put less than 20% down. But the difference is that with an FHA loan, let me go back. For a conventional loan, if you put less than 20% down, once your equity builds up and you build up to 20% equity, then you have the option to have it removed because you have that 20% equity built in. So it's not as much of a risk to the bank. But for an FHA program, it doesn't get removed, even if you get 20% equity. You have to refinance out of that loan product to be able to remove the PMI or private mortgage insurance. So it's just something to keep in mind when you're getting a loan, and know that there are going to be additional fees. So the next thing, like I mentioned, is PITI. It's an acronym, stands for Principal, Interest, Taxes, and Insurance. And what that is it's a phrase that you'll hear when you're talking about the loan amount and what your payment will be every month. And so typically the bank, that your lender will create what's called an escrow account, and they average out the taxes and insurance based off of for insurance based off of the quote that you've gotten, and they'll average it out for a year and put a little bit of cushion, and then so on top of your typical principal and interest and your loan that you're paying, the taxes and insurance are paid to your loan holder, and they pay your taxes and insurance for you through that escrow account. So that's where the term PITI comes from. So the next term is comps or comparables, and this is a report that's run by your real estate agent to show them what the approximate current market value is for your home. And this is done by pulling reports on like-kind homes in your particular area. It's usually no more than a mile or so circumference of your area, depending on if you're how rural of an area you're in or different factors. But typically it's like-kind. So for example, if you buy a 3-2, you're going to try to pull comps on other 3-2 homes of similar age and similar square footage. And this is important because in Texas, we are a non-disclosure state, which means that the sales price of your home is not public information, and so it's not available to everybody. So it's only available to realtors and I believe appraisers. I'm not sure who else. Anybody I believe that has access to the MLS. So it's harder to come by unless you're working directly with an agent in Texas, because it's not public information. In a lot of other states, it is public information. So the next term I'm going to talk about is equity, and this is the amount of value over your mortgage balance that you have in your home. So for example, to make easy numbers, if you were to purchase a home for $100,000 and you put $20,000 down payment on the loan, that leaves you with an 80% equity immediately. And that's where that term comes from. So as the value of your home goes up over the years and your loan balance decreases, your equity in your home increases. So that's what equity is. The next term is contingencies. And contingencies are clauses in your real estate sales agreement. So when you're under contract for a home, you will have various contingencies that will allow you to do your due diligence on the home, like order an inspection, and there's even a loan contingency so that you have time to get approved for your loan. These are periods of time that will allow you to back out of the contract without losing your earnest money, which takes us to our next term, and that is earnest money. It's basically a small amount of money that's sent to escrow, which is a third-party company that processes your transaction that's not affiliated with either side. And so that small amount of money, I don't remember if there's a percentage. I want to say it's 1% of the loan, but I don't remember if there's an actual percentage. But it's a small amount of money that's sent to the escrow, and it's kind of something that signals to the seller, I'm a serious buyer. So it's just kind of in good faith type of thing, where you're not just going and telling everybody who's selling a house, I'm going to buy your house for this much. And that's called earnest money, and that's given to the escrow. The earnest money is refundable up through those contingency dates. So for example, if you were to go up to your contingency for your loan approval, I believe it's 14 days, but don't quote me on that. But just say you weren't approved for a loan and it's the 13th day, you can get that earnest money back because of those loan contingencies. The next term we're going to talk about is amortization schedule. Amortization schedule is a breakdown of your monthly payment. So when you get approved for your mortgage and you have your typical 30-year term mortgage, it's a schedule that shows the breakdown of your monthly payment and how much is going to principal and how much is going to interest. For example, if you get a 30-year loan, schedule will show monthly breakdown, like I said, of principal and interest. And then in the beginning of your loan payments, you're going to be paying majority of interest. That's something you should know too. People see it and they get freaked out, but that's just how the loan works, where because it's amortized over a 30-year term. In the beginning, I believe it's even up to the first 10 years or so, you're going to be paying more interest than you are principal. But once it gets over that certain year or certain number of years that you've been paying, then it starts to flip, and then it gets faster and faster. You're paying more principal, and that's how the amortization schedule works. And the last, number 10, we're going to talk about is called a rate buydown. Now, what a rate buydown is when you go and get a mortgage, when you talk to a lender. I'll give myself, for example. I got an FHA loan, and I was still in the process of rebuilding my credit after divorce and just divorce, basically, and not having very high paying jobs. I was still in the process of rebuilding my credit, so it wasn't the greatest. The better your score, the better, and lower your DTI, the better loan product you will get. So I decided to go ahead and buy down the loan. So what is buy down? It's something. It's money that you're going to put towards the closing cost that go towards your interest. So, for example, they call those points as well. So it's additional monies that you're going to be paying at the closing table that will allow you to bring down your rate. And when I spoke to my lender about if it's worth it or not, and she said it's worth it if you plan to stay in your home at least 5 years or more, and then it kind of balances itself out. So if that's something you're not planning on staying in your home very long, you might not want to do it. But for me, I was able to bring it down to, I think, 4.25 is what my rate is, which is great nowadays, but it wasn't that great when in the beginning of 22 when I got the loan. So that's the 10 acronyms or abbreviations that I wanted to go over for you today. A disclaimer: I'm no lender, I'm no attorney, I'm none of those things. These are just my experiences that I wanted to share with you, so that you are armed with at least some information when you're going to talk to a lender or going to buy a house. So thank you for watching, and we'll see you next time.